Hi, it's Darren, and welcome to our investment review for the first quarter of 2021. So today I'm going to cover some of the things that we saw last year, which was a crazy year by anyone's estimation, and some of the lessons that we learned and lessons we learned in the past that we applied to last year, and give us a guide and a window of what we're looking at for 2021. So let's jump into it right away. So the first thing I want to do is give you four key messages by the time this is all done that I want you to walk away with. The first is, I think 2021 is really going to be about moving away from the pandemic trade to what we'll call the reopening trade. So last year, especially as the pandemic first hit, lockdown started to happen, and we became a little more aware of how serious the situation was. The companies that were most rewarded were the ones that allowed us to work from home, order in from home, everything that supported people and industries during the lockdown. Now, we've seen some of that get a bit stretched, and my metaphor is that all the action was really on one side of the casino. What we have to be paying attention to is, after all the money that's been spent, and I'll show you some charts on just how much has been spent globally, as we move into a reopening, right? As we get the vaccinations, lockdowns come to an end, and we're optimistic that happens. As the world kind of begins to reopen, different businesses will be rewarded as a result. So we need to be paying attention to the change from the shock of the lockdown and the disruptions from 2020 to how things become new as we go into 2021. There is a bit of a model that I'm using, and I'm going to put a link to the Walking with Charlie I did back in June, where I talked about the K-shaped recovery and how K is probably a good metaphor for how we think about how different businesses and industries will respond to this. So the straight up part of the K are all those businesses that helped us during the lockdown that have just gone gangbusters and have really attracted all the investor attention. So pretty narrow group. And tons of momentum behind some of those names, as I'll show you. And obviously, they've done well because they were well positioned to help us out when we needed the help. There are other businesses that have done okay, and we think that they will probably continue doing well as we go into the reopening phase. There's other businesses that were really struggling and had difficulty when things were locked down and we weren't out buying things and doing things. That might turn. So we want to pay attention to those businesses that may have been struggling or not done as well as we'd hoped in the lockdown, but they actually may have brighter days ahead of them. So we want to be looking for those. And then clearly there's some businesses that have been so negatively disrupted and impacted, they just may not be coming back. Sadly, I think there's a lot of small businesses, restaurateurs, gyms, and other retailers that they just probably can't get to the finish line for this. They just ran out of money as the world changed on them. And certainly trends that were already in place back before the pandemic have been accelerated in both good and bad directions all through this. So we're going to be trying to pay attention to how do we capture the right ideas and stay away from the wrong ideas. You're probably getting tired of hearing the word the new normal, so I'm going to change that a bit and call it the new nominal. And nominal, this is with respect to interest rates. So I've been saying for years that interest rates were going to stay lower than anybody thought, for a lot longer than anybody thought, which goes back to 1996. That's definitely been the case, and I'll show you just how fast they've dropped. I think we're going to continue to see rates stay low. That will be very supportive of asset prices. And this is going to come because governments are going to want to keep stimulus on to let their economies recover and people get back to work. And somehow growth must solve the problems because they can't afford to pay back all the money that's been spent and will keep getting spent. We've also got central bankers with massive easing and stimulus policies. And unfortunately, to me, we're getting a belief system around some politicians and political parties about something called MMT, or modern monetary theory, which is insanity, to be honest with you. But it basically means as long as you issue your debt in your own currency, you can print all the money you want, which is like me being able to have my own credit card with whatever limit I want, no matter what. I mean, it doesn't really work like that, but clearly the attitude of most Western economies and governments is just keep spending. So that will be positive for risk assets based on the textbooks. Whether we get inflation is a whole other conversation. The next thing the other big message I want you to take from this is that speed kills and history repeats. I did a video back in the summertime when we were quarantined, and I explained how I thought a lot of what was going on sure felt like 1999, and I'm going to keep making that case. So we want to be aware, I mentioned earlier that It felt like all the action this year has been on one side of the casino. I think some people are walking around like at Caesar's Palace at 3 o'clock in the morning, and they're trying to find the next hot slot machine or roulette wheel. So think about that. Just because things have been hot doesn't mean that trend will continue forever. Valuations in some places are stretched to levels that we haven't seen in 20 odd years, and other things are as cheap as they may have ever been. So momentum can keep going, but you need to pay attention to history. Don't repeat the same old mistakes, which unfortunately many people will. I just won't let you. Okay, let's keep it moving here. So good news, the world is turning the corner towards recovery. The GDP numbers we're seeing from the United States, Canada, around the world are improving after the shock of last year, which makes sense. That's a good news story. The other good news story is we didn't see things get as bad as we saw them get after the global financial crisis in 2008 and 2009, when things dropped really dramatically. And you can see that's the green line of how we had 40 quarters after the first decline, it was still going down. Governments have learned that maybe you don't want bad things to keep happening. So they've really done a good job in some ways of forestalling things getting really bad. And how have they done that? Well, by learning the lessons of the past and dropping interest rates with remarkable speed. Now, you can see how in 2000, 2002, they dropped rates from 6.5% down to about 1%. Took them over 30 months to do it. 2007, 2009, the global financial crisis, rates were starting off from a lower level, but they dropped them a bit faster. It didn't take them as long to get to zero effectively. What did they do this time? So this time we were still actually in a low interest rate environment because of 2008 and 2009. So we weren't starting at 5, we were starting at 2.25. But you can see how in just a matter of months, the aggressive interest rate cuts were there, and that was designed to stimulate the system. And that's what happened. So for good or for bad, we'll know in the history books, but clearly it was this incredible and unprecedented rate cutting and stimulus that allowed us to kind of keep things going. And it hasn't just been in the United States or Canada. You can see that globally, many, many countries have done this. The Euro's done it, China's done it, Australia's done it, UK's done it, US has done it, Canada's done it. I just haven't found the chart for Canada. Everybody's done it. The US done more than everybody else. And I'm not sure what the count is right now, but we're something like $16 to $18 trillion of debt has been strapped on the backs of global economies to fight the pandemic, and they ain't done. So that's an enormous thing. This makes what was spent in 2008 and 2009 look like a drop in the bucket. So, and that's important. I'm going to come back to why that matters enormously coming up. And there's the US, as you can see. They are the biggest bubble. So they spent the most, as not just in total, but just as a percentage of the balance sheet. Not as much as Japan, but they clearly were aggressive about lowering rates and pumping money into the economy. And so what was the result? Well, markets dropped pretty quickly when they shut everything down. And, we stood in the office and just watched the free fall happen. I've learned from previous, because this isn't my first rodeo for these things. We learned not to sell in the middle of that. And fortunately, we didn't. But what was amazing to me is how fast everything recovered. Previously, it's taken several years to recover from a drop of that magnitude. Now, the drop we saw was about 34%, didn't quite match what we saw in 2000 and 2007 and 8, but clearly significant. But look how fast it came back up. It was over in 128 days if you looked at one index. So other metrics took a bit longer, depending on how we measure what the market is. But clearly, things improved much faster than anyone thought because the policy response, the amount of money they spent, was faster and bigger than anyone thought. Okay, so that's a big number and a fast recovery. So that 128 days, if we measure it with using the S&P 500, which, as you'll see in a second, may not be the best measurement anymore. And the reason it's not the best measurement anymore is it's because it's an index that it's basically the 500 largest companies in the United States, but it's not equal, right? They don't take every company's 1/500th of the index. They weight it based on the biggest company gets the biggest weighting. And it has this built-in momentum effect because as more people buy into the index, more money goes into the biggest companies at the top. They then get bigger and become a bigger part of it. You see how this works? So that's fine on the way up. And what happens is the index gets more and more concentrated, less and less diversified, more and more risky as the ball as the snowball gets bigger, as it accelerates. On the way up, it's wonderful. It goes up faster than any more prudent and risk managed strategy would, except it ends badly. When the tide turns, the biggest ones get sold first, and they get sold the most, and then that begets them becoming more selling. And we saw that really evidently as Canadians back in 1999 and 2000, when Nortel and JDS Uniphase became almost half of the TSE 300 index. So people thought they were buying a balanced, well-diversified portfolio of 300 of the largest companies in Canada. No, most of your money went into Nortel and JDS Uniphase. So on the way up, you couldn't catch the darn thing, right? Anyone that said, look, I'm going to maybe make sure I don't get over allocated, I'm going to follow the principles of diversification, you looked like a schmuck because you weren't keeping up with that missile that was flying off the ground. But when things turned and Nortel and JDS Uniphase started to go down, they also went down with a jetpack on. So really, really bad. So great on the way up, really bad on the way down. Why am I sharing this with you? Because we're kind of seeing that happen again. So if you have a look at that first chart, you can see right now the top 10 companies, 2 of which are Google, by the way. Google's in the top 10 twice with different share classes. Great company, but you're getting a double on Google, just so you know. The top 10 stocks, they've got something like 33% of the index is just, so you're not buying 500. Most of your money is going into the top 10. A third of your money is going to the top 10, or sorry, 28%. I'll give you the exact number. And even though they contribute a lot to earnings, they're still the biggest weighting. And guess where they are? Mostly in information technology and healthcare. Not a surprise. Again, pandemic, work from home, get healthy, all that stuff. So it makes some sense that that's where all the action is. You just need to know that that's where all the action is. And again, I'll show you. So, and all the other category that did really well this year was home improvement, right? Because we're all at home, so let's go fix the fence and do some renovations and other stuff. So clearly all about the pandemic trade. Look at the other side of that though. Look what didn't really do anything, right? So industrial REITs, all the stuff that supports Amazon, where do they have warehouses? Utilities, banks, residential real estate, energy, hotel, like stuff that historically has been a very consistent, very important part of portfolios. Terrible last year. And especially things like retail and airlines, really, really badly clobbered. Okay, so what do? We also need to pay attention to valuation. So part of the problem is when the index is so concentrated to a small number of companies that are trading at tremendous valuations, everything that it measures also gets expensive. So because of that momentum effect, we're also seeing the valuations get stretched to levels we haven't seen since the 90s. Okay, now you can make an argument that interest rates are lower today than they were in the 90s, so that should support a higher price to earnings multiple. I'm getting ahead of myself, but I think you need to know what expensive looks like, right? So it is getting expensive from that on that metric. So we need to look at that. We're way above historical averages. Now, for most of the last couple of years, we were actually trading in averages. If you go back and watch some of my old webinars, we were trading closer to the median. Now we're more than one standard deviation above. So that's of concern from that perspective. And again, back to the tech stocks, we're going to party like it's 1999 because a lot of them, their relative values are back to where we were in 1999. So just because they've all gone up, we're not really going to chase them. There might be some momentum there. This party can last a bit longer than anybody thought. Just know that the party is not exactly just getting started, okay? People are willing to spend a huge amount of money chasing things. And I want to give you an example of how dangerous that is, because the problem when I make this argument is I look like I'm wrong while the party's going on. I get it. I'm like the neighbor next door going, turn it down. But I'm not wrong, actually. And I want to give you an example of the last time we saw a company trade at these kind of valuations. I'm going to pick Cisco Systems. I'm going to pick Cisco because it's basically the reason it went up a lot in 2000 was because it's the backbone of the internet, right? Everybody's getting excited about the internet. We're all using the internet. We're getting our Blackberries and stuff. It's all very exciting. We're seeing the future. It looks like Star Trek. So Cisco was really the company that most represented the future with respect to that kind of technology. And it traded not at the previous charts I showed you were 22 times earnings. Cisco was trading at more than 30 times its sales. So it's not like they sell for a dollar, they keep a dollar. No, 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 no. They sell for a dollar, they keep some pennies. So they were trading at an incredibly high valuation. And you can see from the chart that surge up, people were willing to pay almost any price because, hey, man, it's the future. It's Cisco. I can't lose on this thing. So they bid it up until it became the most valuable company in the world. So guess what? In 2001, people finally got their calculators out and went, actually, I think we're paying too much. And then it just dropped like a stone. It dropped 80% the following year. In the next 20 years, did the internet get to be more important? Yep. Did all the stuff about Cisco's business turn out to be true? Yeah, everything was good for Cisco. Their sales tripled over the next 20 years. And clearly we're all using more internet. They got more competitors. So you could have been right on the theme. You could have seen the future pretty clearly, and Cisco's part of it. But you still paid too much for the stock, because even now, after the big run up in technology prices, it's still trading at, maybe 60% of what you paid for it back in 2000. So that's a long time to wait to still be 40% underwater. So the lesson from this is you can be right on the company, you can be right on the sector, you can be right on the vision, and still pay too much for the stock. Why did I tell you that story? I'm going to share with you another story that looks kind of the same. Mark Twain said, history doesn't repeat itself, but it sure does rhyme. And although Tesla and Cisco don't rhyme, they have similar words, right? I'm going to share with you Tesla. Now, in our pooled fund, we've done really well on Tesla. We've bought a bit of it. We've played with it. It's been fun. But that's literally because it's been fun. And I think that's one of the reasons Tesla's cars have done well, because they're fun. We know they're not built very well, but hey, they're fun. Like, the lights go on at Christmas time and it has a whoopee cushion. That's all fun. And the stock has become a toy. Literally, it's become a toy. So, because right as of January 14th, it again, price to sales 30 times. So again, people don't care if it makes any money. I want to be part of the future. I want to be part of batteries and space and Elon Musk. The guy's amazing. I want to be part of all that. I'll pay whatever price. Okay. Except when you get your calculator out, you'll discover that if I'm buying a share of Tesla, I'm making Tesla more valuable than the next 9 largest car companies combined. That's ridiculous. There's no way that Tesla sells more cars than the 9 largest car company. No. Doesn't make more money. No. Doesn't have more profit. No. But it's worth more than the next 9. And you don't think any of those 9 are going to be competitors to Tesla? Again, Tesla can have a great product. They can have great tech. They can have a great future. What are you paying for it? And this effect of this massive run-up, when it entered the S&P 500 in December, and it debuted at number 5, right? So that's on the Billboard chart of hits there. And it was right after Apple, Microsoft, Amazon, and Facebook. And the other reason why Tesla was interesting is that it was probably the darling of investors, and it was up almost 700% in 2020. That's amazing. Now, look at that chart. Does that look a bit like the chart I showed you before with Cisco? See the first part of that chart on the way up, and then pay attention to what happened next. Now, I'm not forecasting that's what's going to happen next to Tesla. I'm just saying pay attention to the lessons of history. We can get all the stuff about the future with Tesla right, and people can still overpay for the stock. And pretty much by any metric, I think that's probably the case. I could have also shown you a chart of Bitcoin. Bitcoin is another one that is problematic for investors because there's a whole lot of hype and belief about it. One stat that I found interesting about Bitcoin, I'll read to you, is remember the whole point of Bitcoin is to use it as a currency, but to make another Bitcoin, you have to mine it. You have to mine it by running all these really complicated algorithms, and it takes a huge amount of computing power to create one more Bitcoin. So if we're all going to use this stuff, we need more Bitcoins, right? But to generate the amount of computing power needs a lot of electrical power. And the math is getting to be ridiculous. So according to the University of Cambridge's Center for Alternative Finance, the power consumption of Bitcoin miners is now the equivalent of that of a country of more than 200 million people. That seems to be a bit much, right? So we're trying to say like that's way bigger than Canada. So to make more Bitcoin requires more energy than like several Canadas put together. So I think there's a limit. I'm a big believer in something called Stein's Law, which says if something cannot go on forever, it will stop. That seems kind of simple, but it's very true. So trees don't go to the sky. You can't keep making Bitcoins. So that's another one that I'm leery of. Okay, let's keep this thing moving. Another factor we saw this year is, again, while all the action was in one side of the casino, we saw this gap grow to almost historic levels, which is that growth stocks, which is a whole category, have been clearly where people have been investing. They're looking at the future. Value stocks, which historically have been the place you want to invest. This is the, where Warren Buffett would invest, where you want to buy a company for less than you want to, like you want to buy it at a bargain, right? You want to buy a great company for a low price. This is how most people have learned to invest, right? Buy low, sell high. Growth is buy high, sell it higher. Okay. Well, the gap between those two strategies is about as wide as it's ever been. And we need to pay attention to this, because what makes up growth? Well, what makes up growth and is consumer discretionary information technology. Those at the moment are kind of overvalued. And what's undervalued are things like consumer staples, right? The companies that make, I don't know, shampoo, toothpaste, stuff you need no matter what, pretty boring business, but pretty consistent. And also financials have really struggled. As interest rates have come down, things like banks and insurance companies, they've made less money because interest rates dropped, because a big part of their business is on what's called spread or margin. So they've not been able to make as much money. So they've been punished in the marketplace. And if you look at what is in the value index, it's those same companies. So again, just another way to state what we know the winners and the losers have been. So we want to be very careful about chasing the winners because they're really expensive. And what I learned in 2000 was we didn't do that. We didn't chase tech. I went and bought all the stuff nobody else wanted. And the next decade was wonderful because as sanity kind of returned and people broke out their calculators, everybody that came in late to the party for tech lost 30, 40, 80% of their portfolios. And all the people that walked around and had lots of time to buy banks and other value businesses had a wonderful next decade. I'm going to give you an example of something else that blips my radar. And I'm not going to buy into this today because I think there's other things behind it, but I want to show you just how cheap some things are. So I'm going to show you US Energy. So these are the big oil companies. Yeah, ugly business, not very nice. But at the moment, they're so cheap, they're trading at less than book value. So the market is willing to pay less than the accountant says it's worth if we just scrapped everything. This is crazy cheap. This is like garage sale cheap. This is yard sale cheap. Doesn't mean I'm going to buy it today, but we are paying attention to this because, again, you know it. What is the oldest rule of investing? Buy low, sell high. I'm just showing you what's low and what's high. I'm going to change a little bit and talk about inflation. There's a lot of things that I think are going to come from the amount of stimulus that's been pumped into the global economy and what governments around the world are trying to do. They're trying to reinflate. Well, first, they want us to make sure we're not, chasing at each other and fighting over food at the Costco parking lot. So that's okay in the pandemic. But they're trying to create growth, and with growth comes inflation. So there is a risk that we could, not tomorrow, not in the next couple of years, but in the future, get rapidly higher inflation as a result. Now, on the one hand, the real live example or laboratory experiment has been Japan. Japan has had basically no interest rates for decades, and their inflation is reasonably contained. So it is possible that we don't see its core inflation going up. So that's possible. So we may not actually see the reported inflation number being overly high. But I'm going to disagree with that in real life for a minute, because core inflation is the number that the government tends to use to raise tax rates and raise benefits, and pensions are using core inflation. Core inflation is a basket of goods, but they remove, when they do the calculation, the most volatile parts of your monthly bill. So they remove things like your energy prices to heat your house. They remove things like your gas prices because they're too volatile. They remove, and you can see there, fresh food. They don't include that in the number. The prices are too volatile. So as long as you're willing to walk, starve, or freeze, there's no official inflation. I think we can be smarter than this. I think actually we need to start buckling up. Again, not today, not tomorrow, but we're going to need to be prepared for our cost of living to be rising dramatically in the future. And with interest rates as low as they are, I've had a few conversations with clients in the last few weeks. And what I'm trying to get people to understand is they say, I want to protect my capital. I want to protect my capital. Actually, no, you don't. You want to protect your income. You do not want to be worried about what a dollar buys. Sorry, you don't want to be worried about the price of a dollar, the value of a dollar. What you want to be prepared to protect is not the dollar. You want to protect what a dollar buys you. In a highly inflationary environment, it doesn't matter the dollar. It's how much can you buy with a dollar? What can you buy? So we want to protect purchasing power. And certain assets don't do that very well at all. Other assets do it very, very well. So we're going to be very thoughtful in ensuring that our portfolios for our clients are tilted towards that idea of protecting what a dollar buys. Okay, very important. So let's keep moving. And one of the ways we're going to do that is by continuing to focus on a strategy of dividends. Now, I want to show you that back in the 80s and in the 90s and in the 2010s, most of someone's longer term return in those decades came from the price of stuff going up. Yes, I got dividends. I got paid to own the companies. But as you can see, most of my return came in prices rising because things got better than I thought they were. Things were good. But in difficult times, right? So that's that just little circles to show you how much your return came from prices going up. But in more difficult times, like the 70s and the 2000s, if you didn't have any dividend income, you didn't have anything. Like you really struggled. So to me, one of the first and most important foundations that you have in any portfolio, make sure you're getting paid all the time. If you get more on top, wonderful. But if things struggle, it's those dividends are going to ensure you can still keep buying stuff and keep your lifestyle moving forward, because dividends rise at a rate faster than inflation historically. So to me, that becomes really the life jacket for your portfolio. Make sure you get dividends. Okay, wrapping up. First thing is we're going to stay invested. Anyone that wanted to jump out, tricky. And I get that there's a little allure to timing. I get that, crazy things can happen, but big picture, you have to stay allocated. Okay, you have to stay. And we saw basically the entire movie of investing was just in 2020. Things looked okay. Something came out of nowhere, big monster, wiped everything out. Stay invested, came right back up. Okay, so just hang on tight. And if we get more volatility, I'm going to keep telling you, hang on tight. Okay, because also the amount of money that they pumped into the economy was designed to do that. So again, with the amount of stimulus that's coming, pay attention to the last few times they did that. It was very scary. They came and spent all kinds of money. Markets went up. So just hang in there. Also remember that not all sectors are created equally. You have to stay diversified. And especially now when one sector like technology is dominated so much, be really careful. Yes, there might be some momentum there, but we really need to go and learn the lessons of history and make sure we've got good and probably growing allocations to the stuff that no one was paying attention to. And I want to draw your attention. I didn't do a chart on this, but in November, my point was proved actually. In November of 2020, it was when we first got the announcements that the vaccines were coming, not just, hey, we're working on them. No, they're coming. And as soon as that good news was out, and it looked like now there's some light at the end of the tunnel, all the value stocks, what makes up a lot of our portfolios, had the best month in history. They just jumped off the floor. So to me, what we had been saying to people and we're thinking is that as soon as we see some chance of recovery, all this other stuff nobody wants is going to become interesting. That's exactly what happened. I think you're going to keep seeing that. Are we going to get inflation? I think so, but I think it's going to be sneaky. I think it's going to be absolutely sneaky. I think the official numbers might be low because no government can afford higher interest rates. So I think the number is going to look low. But I think when you go to the grocery store, I think when you go to the gas station, I think when you get your hydro and your power bill, I think that's where you're going to see inflation. And it's going to come not just from the commodity getting more expensive, it's also going to come from taxation. We're already starting to see our gas prices and our electricity prices going up because of things like carbon taxes. I think this is going to continue. And if you don't plan for it or you're not aware of it and you don't have strategies, you're going to go, why is I have the same money I had 2 years ago, it just doesn't buy nearly as much stuff. Right. We got to worry about that. The last thing I'm going to leave you with is an old adage from Bay Street and Wall Street, which is that bulls can make money, bears can make money, but pigs get slaughtered. And it's very hard to not chase past returns. I get it. I got 2 teenagers at home. They've already taught me what FOMO means, which is fear of missing out. I guess we're all kind of living a bit of FOMO now, but there's not much to miss out on when we're all locked up at home. But FOMO's for teenagers, not for wise grown-ups. So we're not going to chase past returns. Those are done. That's over. right? And in my book, Recalculating, I talked about the brother-in-law index, right? Where there's always a brother-in-law, there's always a neighbor, there's always somebody doing well, making money, whatever. They only tell you about the winners. I know, never tell you about the losers. Don't worry about them. Don't worry about the cars in the other lane. It's your plan and your strategy. So that, to me, is the most important part of all of this, is that we're going to stay focused on your plan. We're going to stay in our lane. We're going to stay disciplined. And that's how we're going to keep on track. So thank you very much for watching to the end. Any questions, please email them in, give me or someone on the team a call. We'd be happy to chat. Okay. Thank you very much. And we'll talk to you again.